Welcome to Inside the Deal. I'm Suzanne Stevens. Joining me today is John Douglas. John is a former general counsel for the FDIC and also chairs the Banking and Financial Institutions Group at Paul Hastings. John, you penned an article for the Deal Newsweekly recently on private equity firms investing in banks, and I want to get to that in a moment. But a lot has changed since then. Namely, we've been through the presidential election. We're going to have a new president, Obama, in January. And I want to ask you a little bit about bank regulation and what we might expect. A lot of what we've heard in the news is about executive compensation, but what other areas in terms of regulation do you think we'll see addressed early on?
I think, Suzanne, we're really going to see some consumer regulation, particularly in the mortgage area, and the consumer lending area, and the credit card area. It's a big emphasis, I think, in the Democratic Party, and one would expect that the new administration would follow that same theme.
And will President Obama be able to address those things fairly quickly, or we're in kind of a crisis situation?
Oh, I think he can do it as quickly as he wants. I think he has a receptive audience for this.
And in terms of the FDIC, does the president appoint the chairperson of the FDIC?
Yes, and the current chair, Sheila Bair, is in the midst of a 5-year term. Normally, a new administration would ask for her resignation and would appoint a new chair. It's not entirely clear what the new president will do with Chairman Bair, because she's been such an advocate for consumer protection and mortgage protection and regulation of the consumer issues.
So it's possible she may continue on through the rest of her term? Yeah,
absolutely, or at least for some period of time.
In terms of private equity investing in banks, which is what you wrote about for us in the Deal Newsweekly, a lot has changed since the Fed loosened some limitations on private equity's ability to hold board seats, to communicate with management. But you say that the Fed really didn't go far enough.
Right.
How so?
Well, it could have done two important things. One, the statute lets you go a lot farther than the Fed went. I would view this as an incremental step, a helpful step, but really an incremental step. The other thing it did not do is set forth the basis upon which a private equity firm could make a controlling interest, or take a controlling interest in a bank. It could have done that. It says it's working on it, but it's very slow coming.
And how big of an appetite is there among PE firms to actually invest in such a troubled sector?
I think there's a big appetite, actually. I think there's a sense that we're getting to the bottom, that we're coming to some clarity on asset values, and that it would be a good opportunity to buy.
Any particular firms you think we could see active?
I think we could see several active. In particular, J.C. Flowers has expressed a strong interest and has done some initial acquisitions. There are other firms that have made early acquisitions, perhaps a little too early, but I don't think their appetite is necessarily gone.
So you mentioned you think we have we may be close to hitting bottom, and
right.
I mean, that almost sounds like a good thing in this environment. So you think we could be headed for some stabilization?
Yeah, I think so. I think a lot has happened. The bailout money is very helpful. We're getting some clarity on asset prices, and I think people are getting more comfortable.
Well, we are still seeing banks failing on a regular basis.
And we'll continue to do so.
At every level.
Yes.
Any idea, is there a particular regional banks, smaller banks, where you think we could see real interest among private equity firms to invest?
I think so. I'm not sure that we'll see interest in the sort of smaller than $1 billion bank, but the $5 billion up range to maybe $50 billion is a pretty attractive size for these firms.
Why is that?
They're big enough to make a difference economically. They're small enough to where the private equity investment can give you some real say-so in what goes on.
Well, to bring us full circle, let's go back to a new president coming in. And I realize we're talking a bit of a granular level here of PE investing in banking and a rescue role that private equity might be able to play there. How receptive do you think Senator Obama would be to that idea, particularly in an environment where we're looking at more regulation?
Well, yes, but we have an industry that needs capital, and it would be nice to get the capital in the industry. So I'm not sure that there's a great receptivity, but I'm not sure there's any animosity towards it either.
So the great need that's there kind of outweighs any critics that
I would think
that could be out there.
I would think so. Capital that will play by the rules will be a good thing.
John Douglas with Paul Hastings, thanks for stopping by.
You're quite welcome.
I'm Suzanne Stevens. Thanks for watching Inside the Deal.